When you invest your money into the stock market, it can be very risky, just like any investment that you make. When you buy stock in a company, it means that you are buying a piece of ownership in the company that you have invested your money into. And as a partial owner, you now have a stake in that company's assets, and you are entitled to your share of the company's earnings. So here's a quick example of how it works. When a private company wants to expand its business and it needs to raise money, to do this, it can either take out a loan, which will put them in debt, or the company can go public, meaning the company issues shares to members of the public for a price. For example, if a company needs to raise $100,000 and it issues 1,000 shares of stock at its initial public offering or IPO, then each share would be priced at $100 each. Now in the future, if that company does well and profits increase, then the stock price will likely increase as well. So if you purchase stock at its initial public offering for $100 and the stock price increases, then you as a shareholder have the option to hold on to that stock and hope that the price will increase even more, or you can sell that stock for a profit. But if the company doesn't perform well after its initial public offering, then the company's value, at least in its shareholders' eyes, may decrease, causing the stock price to decrease as well. And if you decide to sell your stock rather than holding on to it in case it does eventually go back up, then you would be selling that stock at a loss. That is what makes investing in the stock market risky. Now, some companies distribute its earnings to its shareholders in what's known as a dividend. Now, if you don't already know, dividends are a piece of the company's profits, and they are issued to its shareholders periodically. But not all companies issue dividends. Mature companies that have a history of stable income are more likely to pay its shareholders a dividend because it shows a company's strength, and that can lead to more investors wanting to purchase its stock. Newer companies that are in its growth stages typically don't pay its shareholders a dividend. Instead, they reinvest the earnings back into the company to help grow the company and to increase its value. A good example of this is Amazon. Not that it's a new company, but I will use Amazon as an example because they have never paid their shareholders a dividend. Rather than paying its shareholders dividends, on top of expanding its retail business, Amazon used its earnings to develop Amazon Web Services, which is a cloud computing software. This has not only helped improve its own services, but companies like Apple, Airbnb, and even NASA pay Amazon to use this service. As it stands, AWS is Amazon's biggest profit driver, but only time will tell whether or not Amazon will choose to pay its shareholders a dividend. So rather than paying its shareholders dividends and reinvesting all of its earnings back into the company, Amazon is now one of the biggest and most valuable companies in the world. Now, as we know, stocks don't always go up. They are sometimes stagnant, and sometimes companies fail and they go bankrupt. This is why stocks are considered to be risky compared to bonds or a certificate of deposit, but an increase in risk has the potential for increased rewards. Depending on your investing strategy, investing in the stock market should be specific to your goals. For example, if you wanted to collect short-term profits, then the goal would be to buy when prices are low and sell when prices are high. But if you take the long-term investing approach, as do I, inspired by the GOAT, Warren Buffett, then you would be looking to buy stock in companies with the mindset that you never want to sell. And to help minimize risk, your investing strategy should include diversifying your portfolio. That can be done by either investing in uncorrelated industries or by simply investing in index funds and ETFs. But diversification should not be limited to investing in the stock market. Starting a business or simply starting a side hustle to help supplement your income can be just as exciting as building a stock portfolio. So now that you understand the basics of stocks, the time for you to start investing is now. If you like this type of content, like, comment, and subscribe, and show your support for this channel. For more videos on all things investing, subscribe to this channel.